Are you or your clients looking for a regular income solution with compelling returns to diversify your portfolio? If so, Neighborhood Holdings may be a great option for you. Listeners of this podcast will appreciate that public markets can be turbulent and finding a good private credit fund can be tough. But Neighborhood's track record, transparency, and investor alignment sets it apart from the pack. With nearly 10 years of consistent performance and a target net yield of 8 to 10%, Neighborhood has a track record of providing monthly income to investors without the volatility of public markets. How do they do this? Where banks invest in mortgages up to 95% loan to value, they also make borrowers jump through a lot of hoops. Many borrowers in transition aren't able to meet those hoops. Neighborhood has partnered with banks and brokers to provide quality borrowers with temporary financing secured by first mortgages at an average loan to value of less than 60%. Where other mortgage funds might take more risk by lending against construction, bare land, or jumbo loans, Neighborhood is focused on your average residential borrower who owns the average house in the neighborhood. Plus, their variable rate with a floor mortgage pricing benefits investors when interest rates go up and mitigates downside risk. Check out the link in the description or visit neighborhoodholdings.com to view the offering memorandum or speak to your financial advisor for more information. That's neighborhoodholdings.com/Loonie Hour. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 177. As always, joined by the three amigos. I've got Rich, Keith, myself. We're all here.
What an intro. I laughed in the middle of it. I'm sorry. I couldn't contain myself.
I want to do Loonie Hour math. Three amigos. And we have Boomer, Rich. Oh, hi, Steve.
Oh, that's not nice. That's not nice.
Hey, that makes sense, though. The three amigos. This sounds better.
Yeah.
Rich, you still skiing?
I'm going to ski tomorrow. I'm going to ski tomorrow and this weekend. Yeah.
Yeah.
I've just been holed out on the top of this mountain, enjoying golden British Columbia. It's beautiful.
If any of our listeners have ever had to put through all the hours of advertising that we have on our pod and wonder where those funds are going, now you know.
Yeah, that's right. No, it's been good. I've been working, believe it or not. And tomorrow I'm going to take the day off and ski and enjoy. It's snowing now, so I'm ready to go. But yeah, there's so much good stuff. What a week, man. What a week.
Hey, everybody's cool with us. A little hello. I was walking through campus yesterday with our little dog and Willis. You guys remember Willis? Anyway, I bumped in this nice young gentleman. And he said hello. He follows the podcast all the time. His name is Jacob. So Jacob, thank you for saying hello and keep on listening. And we'll bump into you again soon. So that's all I have.
Does you call me?
No. He's a capitalist.
There's a lot in your neighborhood. You're sticking like a sore thumb.
There are a lot of commies down in this part of Canada. And anyway, that's where we are right now in Commieland. Wasn't there one of my favorite movies is Zombieland? Maybe they should just rename it.
That was a good movie.
Yeah. It has some great actors in that. So I do like that one. The sequel was not as good. You know, they try to run
Sequels
it
are
back.
never as good.
No, except for Empire Strikes Back and The Godfather. I think that's
It's a good sequel coming out? Happy Gilmore 2.
Oh, no, that's going to be dumb. I love that movie. I don't want it to ruin any of the thoughts. And
Anyways, I was watching that Swing Netflix documentary, and apparently all the PGA stars are making an appearance in Happy Gilmore 2.
Oh, that's cool. Okay, maybe I'll watch it.
There you
Anyways,
go.
okay, no more banter. End of the banter.
There's the
starting
banter.
right now.
Everybody fast forward. Someone timestamp this. It's over.
Yeah, one dude said, "Oh, I don't want to hear a banter. I want to hear your stock market, real estate, U.S. dollar predictions."
He wants all the hot stock picks.
Yeah, that's it.
Start dropping some tickers.
Today we are announcing 98 hot stock tips. So number 98, no,
Number 1, Brookfield.
Oh, yes.
All right, we'll get to that. But yeah, lots going on in the news. Obviously, we've got Canadian bank earnings. We've got lots of volatility happening in the bond market. Rich, we had the German elections, which we've been kind of monitoring relatively closely. We've got some stuff going on in China. The EU, all the tariff stuff is ramping up again. We got some steep sell-offs in the crypto market. So there's definitely like a lot of like market activity going on right now. So we'll kind of sift through that. To start this week off, Boomer, Canadian banks, obviously front and center. What are you seeing in there? I mean, we've been kind of tracking like loan loss provisions, trying to sort of gauge how the banks are going to handle this. I've got some stories I want to share, but I'll kind of go over to you and give me the highlights here.
Yeah, sure. I mean, first of all, so everyone understands and appreciates when a bank reports their earnings, if they ever fail not to beat estimates, something is serious wrong with the bank because they have so many moving parts they can just move, to make the goal bigger or make it closer to them. So this quarter, you see the blank bank beats estimates on strength in capital markets. Another bank, they beat estimates with trading, you have stuff like that. And again, you don't get too excited with those things. Instead, a serious investor wants to look at what are they allocating, for bad loans. And it was kind of funny. One of the banks, because we won't say the name of the banks here on air, but one of their banks, what they reported for provisioning for bad loans was about 90 million less than what analysts were expecting. So if you put that back in, the earnings beat, it wasn't that awesome after all. So just to give you an idea on what to look for with these companies. So with the provisioning for bank loan losses, because what we talk all the time, Steve, when you talk about the housing market, and X blank, providing a blanket appraisal, yeah, for the total initial value, things like that. What we're seeing now is that all the banks, they've increased provisioning again. So they're putting aside money in case they have to write off bad loans. And you also have to look at what is that as percentage of their total loans that's outstanding. And what you want to see, where is that headed? So right now for these banks, they're all now, the amount that they provision for bad loans as a percentage of loans is back to the same amount they had allocated back in 2014, 2015. That was back when Canada had that enormous recession. Remember the economy was just falling apart then?
Wait, what?
Steve, don't you remember?
I'm not listening to you.
Do you remember the Great Canadian Recession in 2014?
Never been a Great Canadian Recession.
2014, man. I was.
Of course there wasn't.
Out of it.
No, that's my point. That's my point. So the amount of money they've allocated for bad loans is the same level as it was back in 2014 when the economy was healthy, right? Everything was good. So again, maybe all this is great and we don't have to worry about the Canadian economy going forward. Maybe per capita GDP has troughed and bottomed and things get better from here. But again, if you're a risk manager, you're worried about if the economy does fall over, it falls off the cliff, then banks are in big trouble. They're going to have to significantly increase their provisioning. That's the first comment.
Yeah. Oh, well, I have some interesting stories. I think we've chatted about on this podcast, right? Which is, a couple of weeks ago we introduced what's happening with the blanket appraisals on new construction condos. Particularly the big two are RBC and TD. They're the ones that actually kind of do this product, which is essentially they'll do appraisals on these pre-construction units and they'll just say, well, we'll give you your loan 80% loan to value based on this appraisal that we did, 6 months ago, or in RBC's case, 2 years ago. And so what effectively happens is as the values are declining, they're still loaning as if the values haven't declined. And so you can get into scenarios which we saw in the Globe and Mail where, they're being offered essentially they're being offered 100% loan to value mortgages. So that's kind of one way the banks are maybe massaging some bad loans. Number two is just having more and more conversations with people in the industry. One of the things that's going on, of course, we've talked about is the negative amortizations, the amortizations that are blowing out, right? So when you go in there and you sign up for a mortgage, you typically go for, like, let's say, a 30-year amortization. And what was happening was, of course, if you're on these variable rate mortgages, is basically they all blew out past their basically past their threshold. I don't know what the term is for it, but essentially what's happening is people weren't even paying all the interest. So the payment would stay the same. So it was called a fixed payment variable rate mortgage. So your payment would stay the exact same. When rates went from basically 0 to 5, your mortgage payment stayed the same. But what happened was less and less was going to principal, to a point where you were actually paying zero principal and you actually had deferred interest being tacked onto the balance of the mortgage. So the mortgage balance, the loan amount was actually growing.
Was this for Europe? Is this Europe you're talking about?
Yeah, the economic fantasy land in Canada. And so just chatting with some of these mortgage brokers, you guys know that 60%. So 60% of all mortgages are renewing over the next 24 months. So what's happening right now, if you're in the mortgage business, is you're busy pretty much with refis. So everyone that took like a 5-year mortgage during the lows during the pandemic, you're coming up for renewal now. And then you got a lot of people in 2022, right? As rates started going up, a lot of people took like 2-year and 3-year fixed rates because they didn't want to lock in for 5 years, right? Because rates were moving higher. So you got a lot of those loans, those 2- and 3-year loans, that are also renewing in 2025 and into 2026. And so, just having conversations with these people at the bank, is I'm hearing stories of, and these are like credible, like some of these amortizations are north of 100 years. Yeah, I was chatting with a guy at one of the big banks. Again, I'm not going to name the name. But he's like, yeah, he's like, I'm pulling up my screen right now. I'm looking at it. Yeah, this guy's got 143 years left on his AM. This guy's got 151 years. Like, he's like, and you're like, wow, like what's, I don't know what these people do on renewal. I mean, basically,
I thought there were rules though, Steve, in Canada where they couldn't. Like, I thought amortizing past 30 years was a big deal.
Yeah, it is a big deal.
Didn't they come up with rules? Like, I thought even 40 was now the new max.
Yeah, no. So contractually, you can only have a 30-year AM. So when you and I, like, if you go buy a house, you can only go to the bank and get a 30-year AM. But during the term of that loan, because of these interest rates going up so quickly, it blew out these amortizations. And so contractually, the way OSFI looks at it, the banking regulator, is on renewal, you have to get that loan back onto your scheduled AM. So I'll give you an example. Let's just say in 2020, you signed a 5-year mortgage term, 30-year AM. You're renewing this year. The AM's gone from 30 years to 65 years because you haven't been paying all the interest. There's now 30 years minus 5, so you've got 25 years left on like the term and the AM. So you have to basically, they're going to send you a renewal in the mail and saying, okay, your balance is the same or larger. You now need to fit that remaining loan in a 25-year AM. Now, what you can do is you can go and refinance, assuming that you qualified. You can refinance that back out to 30 years. Right. But you can't have it at 65 years. Now, what we're hearing is,
so what's happening with payments then? Like, what's the punchline for the average guy now?
Yeah, payments are obviously spiking, right? And so people are either going to have to come up with excess money to sort of pay down the loan balance. They're going to have to refinance it back out to 30 years. They might have to sell the property. So I think truthfully, what I'm hearing behind the scenes is that, the banks are working with borrowers, and I think there's a little bit of leeway there, where if you can make a hardship case that, like, listen, I can't make this work, the banks are going to make some exceptions, and maybe it's not a 30-year, maybe it's a 40-year.
But wait a second. I mean, The different I mean, hold on a second. That is an incredible amount of an extra interest payments that you are making. What people don't realize is it's nonlinear. It's a logarithmic function. And so adding an extra 5 years of amortization for a loan increases your interest payments for like a regular thing by like 25%. Like those 5 years mean like a 25% increase or 25% increase in interest payments as a percentage of your total interest payments. Does that make sense? Like it's not one for one. That's crazy. That is.
Yeah, but the goal though is to make the payment more manageable for the family.
Oh yeah, no, don't get me wrong. Yeah. It's great for the banks though. The banks are
so like this is why I've always said like the reality is in Canada, let's call it what it is. You basically have call it 5 banks that effectively run the country. And so their motive or their incentive is they want to keep everything like even the government, right? The federal government that's in charge, like they don't want a whole bunch of people on the streets, bankrupt, foreclosed on. They don't want us looking like the US in 2008. And so I think everybody's kind of closed their eyes and says, okay, do what you need to do to sort of keep everything smooth to the best of your ability. And so, I mean, I think that's the reality behind the curtain. I think everybody knows it's a problem, and we certainly don't have like that free market, right? It is what it is.
So, I mean, that's death by 1,000 cuts. I mean, this is the problem. I mean, this reminds me of what happened in Japan. So, like, the problem with the Japan housing and asset bust is that because, like, basically banks refused to write off all these debts, because they refused to write these debts off, you just had these like zombie companies, zombie assets just exist in perpetuity. Because everyone sort of knew they weren't going to get paid, so they extended the maturities. These companies' assets weren't worth what they were supposed to be. Worth the market value was much lower than sort of the book value. And then this pushed, and so in at the time it sounds like a good idea. Oh, we don't want anyone to go bankrupt or get kicked out of their house or whatever it is. But in practice, what happened was you basically had an economy with all these dead, bogus assets that were on these balance sheets forever and ever and ever, and it really hurt the economy over a long time. There was never any cleansing or market sort of recalibration of these assets. And contrast that example with the United States, which was sharp and painful, but at least people who needed to go bankrupt went bankrupt. The assets that were needed to be devalued were devalued. Things that, banks that needed to be recapitalized were fully recapitalized, and you had a sharp and quick, I mean, it wasn't a quick recovery, but you know what I'm saying? It wasn't the 30, 40 year recovery. It was a 5-year recovery. And so I think that this is not a good thing at all. And I think the only real winners from this are the banks that are going to get huge amounts of interest payments over a 30 or 40 or 50-year amortization.
But Rich, I think the listener, our audience, I mean, they know your affinity for Japan, and it's such an awesome place to be. So if you're now saying Canada has become Japanese-fied, what is the word?
Japanified? I don't know.
Japanified? Japanified? Okay, but the economy is coming now to look like Japan. That's what you're suggesting?
Well, I mean, there's no free lunch, right? There's always there's no good and bad. It's just trade-offs. And what we're trading off is, instead of these assets being appropriately valued, banks having to take capital hits, people having to sell and move, what you're doing is you're having people who should not be paying these mortgages basically being indentured slaves, right? I mean, that's what these assets are not worth what is on the tin, right? Those assets should be.
I told this story before. About 12 years ago, I met Mark Carney at a Bank of Canada event, and I asked him the question.
I think you told that story on the pod. Is that real? Was it Carney though?
Yeah, it is. Yeah, it was Mark. Yeah. And it's kind of interesting because the reason I tell the story again and again, because old people keep telling the same story all the time. But it actually aligns with what Rich is describing. And I asked him, said, how do you feel about socializing the bad debt problem? And that's when you take a bad debt problem for a very specific part of the economy, and you make everyone pay for it. Mm-hmm. And the way everyone paid for it back then, which was led by the Bank of Canada, and Carney was leading the bank then, was by bringing rates down to zero. so as to encourage borrowing, but it screwed over the little old lady who wanted to go play bingo on Saturday nights because she wasn't getting paid with her GICs or anything. So what you're saying, Rich, is the exact same thing. So by having banks not able to take they're not being forced to take the charges on their balance
Whoa.
sheets against assets and capital, as well as their income statements, then, and if you're smoothing it out forever, that's socializing the bad debt
You could
problem.
you could also argue that that little old lady playing bingo, Mark Carney at the Bank of Canada kept her asset price artificially inflated.
Yes, absolutely.
She owned her house free and clear because she bought it for $30,000 in a tin of blueberries in 1968. And now it's worth $3 million. And the price doesn't reset because there can be no bad loans that get materialized.
I'm just saying, yeah, exactly.
And also, it's forced her to push out her investment risk exposure without realizing it. So instead of being on GICs, she now has a portfolio of investment grade bonds, high yield bonds, junk bonds, preferred shares, private credit, which is awesome apparently. And, and again, everything is set up for, eventually risk will be expressed. Remember, we did have that last decade, which was led by a bunch of central bankers back then, that, risk was not allowed to be expressed. Not at all.
Right. I'm just saying that I think that we need to disabuse people of the idea that there's no negative part to the story. There's hugely negative things to this story, whether it's people who will be in homes that are ultimately worth less than they think they are, or the fact that they will pay way, way, way more in interest than they bargained for or that they should be. I mean, just to give you a quick example, ChatGPT, for a $500,000 loan at 6% fixed interest rate, a 25-year mortgage, the total interest paid is $460,000. For a 30-year mortgage, the total interest paid is $580,000. So, I mean, I guessed 25% because I'm neurotic and I wanted to make sure I didn't get it wrong. I double checked and I was right. It's about 25%. Those 5 years will cost you 25% extra interest payment.
I guess it depends how quickly that debt is being devalued over a 25 or 30 year period.
That's the thing. And then, but also then there's like knock-on effects to my favorite word ever is productivity, and on and on and on. I'll skip that for today. But I think this is a really dangerous precedent that is obviously going to happen.
Right. Wait. So now again, I mean, we're probably dragging this on longer than it needs to. But I mean, at the end of the day, when you have this bad debt problem, I mean, what's one of your exit strategies? It's basically to debase the currency and essentially try to paper over it. And I think that's kind of what we've seen. I mean, if you look at, my favorite thing is you look at house prices and you denominate them in ounces of gold. And, people will be surprised to see that places like Vancouver and Toronto, since, basically peaked in, I think, 2006. And since then, housing has actually gotten cheaper in ounces of gold over the last 20 years.
Well, to be clear for everyone, this is not a problem right now. That we don't want you to leave. We're not suggesting the Canadian banks are chock full of bad loans that they're not properly recognizing. The risk is that we do go into a deep recession and then they have this, moment of truth coming up. So we're not there yet, just to be what we like to talk about, of course, is to prepare. So, the 15 listeners we have here every week, we had 20 last week, Rich. It's come down by 5 maybe. We can prep you guys. We can prep everyone.
Well, let me give you one more story of kind of like just something that's always kind of stuck in the back of my mind. This is a conversation I had with the gentleman a couple of years ago. I get this phone call, hey, I've got this property I bought near the top of the market. It was like a new construction house. I think he paid, I don't know the exact numbers. I think he paid like $2 million at the top of the market in the suburbs. And, he was renting it out as an investment property. And I said, I said, well, I could probably sell it to you today. I could probably resell it if you want out. I can probably sell it for 1.8. You paid 2. I can probably get you 1.8. And he's like, oh, no. Like, I can't take that kind of loss. So I'll just keep renting it. I said, oh, well, you're going to keep renting it. That I'm assuming you must have locked in your mortgage rate because, most of the investors that didn't, I mean, you're obviously your negative cash flow has gotten significantly worse. I remember him saying to me, no, I've got this mortgage with TD. And, I'm just deferring the interest. I think he was deferring $800 a month. So his balance was growing $800 a month, and his amortization, of course, was blowing out. And I have to think, I'm like, I don't know where that gentleman is today. I haven't chatted with him, but I'm like, okay, well, I mean, he's got to be coming up for renewal like pretty quick here. And sure, variable rate mortgages have come down, but I mean, there's still going to be a problem on his balance sheet that he's going to have to deal with. And so
do you think the bankers are aware of this conversation and that they have any concern?
I mean, they should.
No, they just want their bonus at the end of the year.
Yeah, but so and then I look at it and say, well, okay, you start looking at what's happening in the new listing space. The new listings are running at 20-year highs to start the year, and so maybe finally after the last 2.5, 3 years of rising rates, I think maybe there's a small cohort of the market that's finally sort of capitulating and saying, okay, well, this isn't sustainable, because we've seen house values rebound a little bit, but more or less, I mean, they're still lower than they were a couple years ago. So, you're kind of in this, I would say you're really, like, if you look at it and you be honest with yourself, you're really kind of in a flat-ish market. So there's really, like, you don't have any real growth there to sort of bail you out on the resale side. So, or even on the refinance side, you can't go back to the bank and say, well, the value is worth more, so let me refi, take on a bigger mortgage. So, like, anyways, it's just coming to sort of, it's coming to its conclusion, I think. And it'll be interesting to see how it shakes up over the next 12 to 24 months.
But sorry. I know we need to move on, but that's a really, really important point that I want to reiterate, Steve, which is the whole premise of this is that people think that they'll be able to sell up again, that the housing market will recover and have another 20% year or 30%.
So that was the conversation that I had with him, was basically like, oh, well, I'll stick it through, and I'll wait for the valuations to basically recover, and then I'll get out. But like I said, the valuation, in my opinion, really hasn't changed. Like, okay, maybe I told him 1.8, 2 years ago, maybe he's 1.85 today. So he's up marginally from sort of the lows, but like it's not enough to get him out. And I did this exercise. I put it on Twitter, which is, you look at some of these markets in Vancouver, and I'm sure the GTA has got a bunch of them too, where downtown Vancouver condos are down. Since they peaked in 2018, they're down 15%. But now in real terms, inflation adjusted terms, they're down 30. They're down 30% in real terms since 2018. I go to a detached house on the west side of Vancouver, a neighborhood where I live in, and that whole pocket peaked in 2016 with the hot money flows from China, and I think it's only down whatever. It's down, I don't know, 5-10% since 2016, so marginal. But again, in real terms, it's down 25+%. So if those markets haven't moved in 6 to 8 years, I mean, I think it's reasonable to say maybe other markets that peaked in 2022 at the top of the, at the bottom of the rate cycle, maybe those go through another 5, 6, 7 years of just no appreciation. And what does that do to some of these problem loans? So anyways, long story short, I think it's a space that is going to be interesting to monitor as you get about 60% of the mortgage book turning over the next 24 months.
Just something else to add to it. I this is my view, and I know I'm right, of course. But it's my view, the Canadian banking industry, they're having this drunken orgy fueled. What's the Greek god of love and wine? Dionysus? I don't know what his name is. Dionysus. That is happening. And what they're consuming is arrogance. I think there is an extraordinary amount of arrogance in the credit world. And I know a couple of conversations that I heard recently. One guy commented that their loan portfolio was bulletproof. They have no worries whatsoever about this. And another guy commented that their entire loan portfolio was backed by the Canadian government. They don't have any worries about this. And again, you just have to, either, drop your jaw or roll your eyes. We do both at the same time.
I don't think I can do that.
I can't. That's hard to do. Just try.
Everyone
It
that's
is hard to
watching
do.
on YouTube just get to
Yeah.
enjoy that.
That's weird. But my point, though, is with, I'm a big believer in culture of any organization, because it really shows who you are, how you respond to things, how you react, how you're proactive, how you run everything. And I think people know, of course, that, if you understand the way the credit world works, and we did have a decade with no risk being priced, zero rates, socializing the bad debt, and the bingo lady, paid for it and everything. And then we've never had a serious recession in Canada at all. And, so this belief for any senior banker to believe that their loan portfolio is bulletproof, or everything is insured by the government of Canada. So if something did go wrong, they can call Ottawa and collect. And not only is it arrogance, it's just complete unawareness of how credit and money really works. Because again, no one has experienced it yet. There's just still, let's fool around with the amortization table a little bit. I'll hold on to my property because it'll come back in value in 2 years. Steve, I'm sure there's been a period in time where housing prices, they've only averaged maybe a 2 or 3% a year increase. If you
I
go
mean,
back,
I can tell you without a doubt the conversation that I'm having quite frequently with a lot of people that are calling, reaching out, is I've got this investment property, and what do I do with it? The resale market's not where it needs to be. The rental market's softening. And, just trying to explain to people that, listen, like, the last 10, 15 years of growth, you can't expect the same. And I just keep going back to them and saying, I don't know where the market's going to be, a year from now, 3 years from now. But what I can tell you is, like, if you look at, again, parts of the market in good areas, west side of Vancouver, that has not moved in value in 8 years. So maybe your townhouse in the suburbs, maybe after doubling over the last 6 years, maybe that goes sideways for 8. And I think that's a really hard
Pill to swallow.
thing. Yeah, it's a hard pill to swallow, and I think they just they don't want to hear it or believe it. And
you can wash it down with a glass of arrogance, and then it'll be easy.
Oh my God.
Did you know that your personal data is being bought and sold online without your consent? Your name, location history, even your login credentials are out there, waiting to be used by advertisers, scammers, or worse. And with data breaches rising by 68% in just 1 year, the risk is only growing. Data brokers are collecting and selling your private information right now, and once your data is out there, it's nearly impossible to get it back unless you have Incogni. Incogni does the hard work for you. They contact data brokers on your behalf, demand removal of your personal info, and even follow up to keep it off the market for good. Take back control of your privacy in just 3 easy steps. Sign up and let Incogni know what data you want removed, grant them permission to work on your behalf, and sit back while they handle the rest. Try Incogni risk-free for 30 days. If you're not satisfied, you'll get a full refund, no questions asked. Protect yourself today at incogni.com/Loonie Hour. That's incogni.com/Loonie Hour. Incogni, because your data should belong to you and no one else.
Keith, so this kind of brings us to the next point here, which is obviously as a Canadian banker, you're looking at this and saying, well, we can kind of sweep a lot of these under the rug. But one issue that might cause more problems is the labor market in Canada, and particularly as it pertains to what's happening with the tariffs, right? I mean, if you get more job losses, it becomes difficult for people to pay their mortgages, et cetera, et cetera, et cetera. And so we've had some updates. I know, President Trump is kind of all over the place. But as of today, this recording on Thursday, the tariff stuff is coming back. We're told for March 4th. So 25% tariffs are supposed to be coming back on. I think we had a 30-day reprieve there, and all indications suggest they're coming back on March 4th.
Yeah. I guess I need to eat a Twinkie because I suppose I was wrong. which
But
is
like, I don't know. I mean, are they coming? Are they not coming? Well,
I mean,
on March,
I still think it's a negotiation tactic, but I think I've made the mistake of thinking I can predict Donald Trump's machinations before, and I won't do that again. I just, yeah, I think it'll be really, really interesting to see how that impacts gasoline prices in America, because I think gasoline prices in America literally move the political needle there. And as I've said before, they import an incredible amount of heavy crude, which is used in refining, et cetera, et cetera. And so I don't know, Keith, if you had to jump in there.
I think it's an absolute gift. I think this has been handed to Canada on a silver platter. And what that gift is, it gives all of our governments, federal and provincial, sit down at a table, blank notepad, and say, let's start a country from scratch. Let's get rid of all of our own interprovincial tariffs. Let's get better with reduced regulation and things like that. Because you have to look at it from, if you take the perspective that the Americans are going to do this, and no matter how many fancy groups with nice suits and stuff we send down to Washington, and they meet a lobbyist and they get a meeting and they write out their notes and memos of what might happen. If you go with the premise that, hey, these are likely going to happen or they're not going to happen with tariffs, that is, and that's no way to run your economy. Instead, you should say, hey, we need to really change things up here. We have this potential really bad debt problem for our credit system. We just went through this bizarre strategy of population growth, which created all these other imbalances. Again, everyone in Ottawa or any province right now listening to this, like, please get your act together. Take advantage of this, because now you're allowed. Because think about this: a year ago, if the Canadian premiers got together or one came out on their own and said, hey, we should eliminate provincial tariffs, they would have been booed off stage.
Yeah.
Now you have a chance. Hey, we should talk about this. Why don't we actually state them all, put them all out there so people in the public can see it? And then we'll realize, you know what? Okay, we're going to fix the whole tariff thing with the Americans. And then we can also do this internally, domestically. And we're actually going to be better off for it. I'm an optimist. When we went through that three episodes ago,
we did, and I think you're reminding me of a very famous quote: "Never let a crisis go to waste," or whatever. I screwed that up.
Never let a good crisis go to waste.
Yeah, that's.
I don't think it was meant to be interpreted that way.
What do you mean? That's exactly what you just said.
No, I think that quote though means someone will take advantage of it for their own means.
Haven't we been watching exactly that play out? Anyways.
Oh yeah.
But no, I agree with you, Keith. And you're right. It is an opportunity for.
I think it's stupid. I mean, like, for example, they're giving it to Gretzky for not wearing the Canadian jersey at a hockey. I mean, give me a break, guys. There's a lot more important things going on with our economy and policies, but instead, that's what we're geared towards to think and
I mean, okay, let's call it what it is. The media and I think the Liberal Party is clearly using this whole Trump stuff to really enrage Canadians, right? He is now the number one enemy of the country, and they're taking the attention away of Canadians of the last 9 years of economic mismanagement, flat to declining GDP per capita, 40-year highs in inflation, housing costs doubled, all the problems, rampant immigration, destroying our immigration system, all the crime, everything that's sort of gone wrong in the country. They're using brilliant strategy. At the end of the day, let's call it what it is you kind of take people's focus away from those issues, which were front and center. And now the whole conversation, you go on CBC News, all they talk about every day is Trump, tariffs. How do you deal with it? Who's the right person for the job to deal with this? And clearly you're seeing that in the polls as well, right? And you actually see it in the polls. Canadians, number one. So there's two things right now at the top of the polls that are showing what do Canadians care most about today? And it's number one, it's the Trump and Trump tariffs. And I think number two is the labor market and concern about job security. So those are the two things front and center. I don't know, pre-Trump getting back in, it was like inflation, labor market, crime, like, you know what I mean? So the conversation's clearly shifted. And it is what it is. So
the red shirts have taken advantage of a crisis and not letting it go to waste.
yeah, I mean,
Yeah, that's
the
the way I
100% they
look
are.
at it.
And again, regardless of your one's political views, I mean, let's call it what it is. I mean, it's smart political strategy. It's disheartening at times to think that Canadians have forgotten
How we got
about
here.
how we got here, right? And all the lost opportunities. I mean, the countless guests that we've had on the podcast that are experts in the natural resources space that have said how poor of policy we've laid out over the last decade has then put us in this vulnerable position that, we only have really one customer. and all the lost opportunity. And, of course, now that we're saying, oh, we're going to reverse that. Yeah.
Again, I just think the amount of arrogance by the average Canadian to believe the 2 bullet points that they're told every night, that is their view, instead of, man, like try to really figure things out. Or what is the most important concept that's happening here? And, you're not trying to make this, about the Americans and what they want to do and stuff. Guys, like the country has literally gone down the toilet. If you move to another province, try to get a doctor. You cannot get a doctor
No, it's
today.
like the waits are 30-year long.
Bring your kid to the public
30-year
school, like
So
drop them in there, and you're going to go, holy smokes! Why are there 40 kids here in class?
So my mom grew up in Delta, BC. So I used to live there, part time with my mom. And so like Delta's, I don't know, 35-minute drive from the city, from Vancouver City. And anyways, we have Delta Emergency Hospital. And you can ask my mom, like I've been there countless times. I was like a total band-aid as a kid. And but just a couple days ago, like that shut down. They shut it down for the weekend because there was no doctors.
Crazy.
You're like, this is like a decent sized emergency room that services like the community. And like this just shut. We don't have any doctors, so we're closing the doors. So if you're like,
and this has been going on for years, right? So why hasn't that been the most critical conversation every single night on every single media platform? Like the hockey game gets paused in the middle by a hockey player making an announcement. We need to do better. I'm being, whatever you want to call it right now. But again, I think people know my view on this whole terror thing right now. Like, fix it, get it sorted out. But you're treating the symptom to a significantly bigger problem that we have in Canada. And my expectation is it won't get fixed. I mean, people believe what they're told and they think it's their own view. And if we get a recession coming up here, again, maybe we don't, maybe it doesn't happen. Maybe everything, gets a lot better. If we do, it is going to just rip the soul out of the country because it is perfectly set up for it. You couldn't write an economic textbook and there's 10 chapters, and the 10th chapter is economic, deep recession, and everything else that the conditions needed for the 10th chapter to happen. We've hit them all in Canada.
The problem, Keith, is that people will blame Donald Trump, and in a way, he might be the cherry on top. But I think we've made it very clear that this was already sort of happening. And I think that's the frustrating thing from someone who loves economics and tries to really see the forest for the trees and works really hard to get the data right, is that it's already been deteriorating.
Did you guys see Mark Carney's thing on the it was, it's circulating obviously on the debates. So he said this, maybe he's listened to the Loonie Hour, but he noted the same thing. He says, let's be honest, you got the Trump tariffs, which are, going to hurt us economically, but the economy, his words was the Canadian economy of the last 5 years was not in a good spot.
If only he had an opportunity to help advise the people who were in charge of the.
Right? Yeah. It's funny. It's kind of a bit of an own goal, but obviously,
Well,
again,
I mean, credit to the guy for admitting that all of his policy decisions, or excuse me, a lot of the help that he gave our dear leader were a complete disaster. I mean,
well, you kind of have to distance yourself from it as well. But but on face value, if you take things for that, maybe there is an opportunity here.
yeah.
And but like as for like this March 4th date, Canada cracks in two or something. I don't think that's going to happen. Um, again, we have much bigger challenges that could come very, very quickly because of the mortgage story that you shared with us, Steve.
Yeah.
Because of the bank provisioning story that we talked about it as well.
So-
What's next? What's next?
So let's unpack this a little bit further, which is like, you got the tariffs obviously in Canada, but like, he's promising them on the EU. The EU is now trying to do a trade deal with India.
Yeah.
You got extra, he's saying there's an extra 10% tariffs on China coming as well. So I don't know if you want to walk us through some of that story, because I think it's important.
Well, I just think the U.S. is one of the countries that has probably the least inbound tariffs in the world. I think we've shown that or proved that. I can't remember if it's in a webinar with Keith or on Twitter. It's all getting sort of muddled up. But if you look at every country and you say, okay, country X, what are they tariff coming in, and what are the tariffs that they sort of face going out with respect to their exports and imports? The U.S. is probably at the low end of the scale. Other countries like India are at the very, very high end of the scale. And there's also non-tariff barriers. So for example, for a while, you couldn't buy an iPhone in India because a certain percentage of the electronic components in an iPhone had to be manufactured in India. And obviously Apple's not going to do that. They have the Foxconn in Taiwan and China and whatever doing it hyper efficiently. They're not going to rejig their entire supply chain in order to sell an iPhone in India. So they effectively didn't. Right. And so India has huge tariffs on all kinds of products and services in order to protect industry. Right or wrong, that's the reality. What's really, really interesting that came out, I think, yesterday was that the EU, another trade bloc with enormous tariffs to protect their local industry, FYI, asked India to cut tariffs on cars. Europe is one of the largest car auto manufacturers in the world, so vehicles and parts, trucks, etc. And India has huge tariffs on car imports. Obviously, EU has had their export market in China decimated as China subsidizes electric vehicles, and China becomes the largest exporter of cars in the world. So the EU is basically knocking on India's door to say, hey, India, can we talk about the tariffs that you have on, and can we reduce them? And so we'll see what happens. But I think it's really interesting that the European Union is basically actively trying to rotate or shift their economic exposure away from China. I don't think it's a coincidence that this is a clear foreign policy decision or direction from the US, as it's been explicitly said repeatedly by Marco Rubio. Again, please listen to his speeches. I just thought that was a really sort of interesting wrinkle in what we're seeing, right? Germany's getting killed with respect to their auto industry and manufacturing for a bunch of different reasons. One of the reasons is because they no longer really sell as much to China. And so they're looking for new markets, and this tariff language comes up again. So I thought it was interesting to share.
So where is their opportunity then that they will strike some kind of a trade deal with India? What's their end game with it?
I mean, India is an enormous market that's frankly underutilized. I don't know what the number of cars per 1,000 people is in India, but I would presume it's extremely, extremely low relative to China, or certainly America, or certainly Canada, or the United States, or whatever. And so as far as a growth opportunity, I mean, India's economy is growing. It's been doing very well. They have a massive untapped middle class that over the next, let's say, 30 years, if they grow at 4 or 5%, I mean, you have literally hundreds of millions of people that might buy a Volkswagen Golf, etc. And so the idea that they're sort of knocking on India's door and saying, hey, can we please sell you BMWs and Mercedes and whatever, I don't think that's an unreasonable view. I mean, India is a very poor country, and a lot of poor countries suffer middle income traps or low income traps. But if India can knock itself into this new level and start to become a consumer-based economy that starts to borrow and spend and buy cars, etc. I mean, my goodness, there's 1.4 billion people who live there. And so I
So
think
they're using tariffs, though, correct?
right now, India absolutely has huge tariffs on all kinds of products, all kinds. I mean, everything from like literally everything from the highest technology iPhones and whatever and computers to like spices and salts and shit like that.
So what
I've
are they?
seen some pretty. I was going through the airport today. I saw a lot of people protesting at one of the gates about Indian tariffs on stuff, and to see my point, though, we're back to the whole tariff discussion.
Well, what does China do? What does India do with Chinese-made cars? I mean, obviously, I'm assuming China can export their vehicles to India very cheaply.
They don't. I mean, India and China have an acrimonious relationship that's quite historic. I mean, they haven't liked each other in a long, long time. And then India produces lots of cars. First of all, India doesn't have that many cars per person. That's the first thing. A lot of their transportation either bus, which they can manufacture in-house, or lots of motorcycles and mopeds and shit like that. And so yeah, so that's important. But India's economy is improving. It is getting richer, and people will inevitably demand cars. This is just the natural order of things. And yeah, so that's why there is an opportunity. I don't think so. When we say China sells EVs to emerging markets, it's a lot of South America, the rest of Asia, etc. Just to give you an idea, so I just quickly pulled it up. World Trade Organization. How do India's tariffs compare? So the average rate of tariffs is 16%. The only country that's higher is Egypt with 18%. And the U.S. in relative is 3%. So yeah. Anyway,
it sounds like with all those European cars potentially heading over to India, they might need a bit more fossil fuels over there.
Well, India is way ahead of you, and India has doubled down on coal. We've talked about that before. They have lots of coal reserves. Coal is cheap and abundant and whatever. And but yeah, India is a really interesting country because there is so much potential for growth, but they constantly sort of get in their own way. And yeah,
Keith, there was a good article from HSBC this week that you flagged.
I saw that.
You want to walk us through that?
So, yeah, sure. First of all, any snowflakes listening, cover your ears. You're not going to like it. So HSBC, they announced that that there's going to be an end to a negative bias towards fossil fuels.
Oh boy.
Yeah, we need to end that right away. Too many people have been negatively biased towards the carbon economy without acknowledging the carbon economic.
Yeah, I read it for you. Too many people have been negatively
My
biased.
writing is not very good here, guys.
Too many people have been negatively biased toward the carbon economy without acknowledging that the carbon economy plays a very important role from an energy security perspective. Was the message from HSBC. The comments show how the concept of climate finance is evolving. Less than half a decade ago, HSBC and its peers in Europe, the US, and Asia signed up to net zero emissions goals that oblige them to align their portfolios with a scenario of 1.5 degrees of global warming. So obviously, yeah, with that, a lot of focus has been on how one constraint or constrict the carbon economy rather than how one can grow or facilitate the new world energy economy. If the world spent more time focusing on that side of the equation, this transition will happen faster and capital will flow more easily.
That's exactly what I was going to say too, Steve. Thank you for covering that. So packing all that together, this is something that I think Rich highlighted maybe about a year ago. Rich, you were ahead of the game, ahead of everyone else as well. But the global acceptance of the whole ESG mandates, things that it's all starting to decline and break apart. So for like one of the top guys at HSBC to say this out loud, not just at the pub, out loud. Again, it's another step towards we are seeing an acceptance that, hey, the pendulum is swinging in the other direction, which sort of in a way ties in with what the the premier from Saskatchewan announced yesterday or today.
Scott
Yep.
Moe.
Scott Moe.
Mo. What did they say?
Mo. 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 I'm sorry, that's a Simpsons
So
joke.
Scott Moe said, he put out a tweet, he says, effective immediately, all pipeline permits going east, west, or south received in Saskatchewan will be considered pre-approved. We encourage all provinces and the federal government to do the same. So again, I'm not sure the legalities of that, but I mean, at least that's the messaging, that's the sentiment.
But if he said that 3 or 4 years ago,
100%.
I mean,
Tarred and feathered.
yeah, I mean, no one will be talking about Saskatchewan except for us. We like to talk about Saskatchewan.
Yeah, we do.
Every now and then.
So
But again, I think that this pendulum is changed direction. It is coming back around. You could either jump up and grab it and go and ride it, or we can try to prevent it from swinging. My concern in Canada, they're going to try to prevent it.
So so just to chime in here, so on this article from Bloomberg here, from HSBC, Rich, I didn't realize this. I know that this is probably part of that net zero banking alliance that Mark Carney was actually involved in. Of course, we've seen all
Involved. It was his idea. He led it. Sorry.
Yeah, he led it, and then obviously we've seen every major Canadian bank has now announced that they've dropped out of that over the last 6 months. So banks right now globally aren't close to the 4-to-1 ratio of green to brown capital allocations that is needed if the industry is to align its business with the goal of limiting warming to 1.5 degrees. So effectively shows the top 10 large banks by 2023 energy supply banking ratio. So basically how much money they're lending to the fossil fuel industry and how much are they lending to the low carbon sort of green industry. And of course, I think, Rich, we talked about this. Was it Texas, the state of Texas, that was out effectively trying to sue? Was it the banks they were trying to sue?
No, they sued BlackRock. It was the Texas pension fund, which is an enormous chunk of change. Like,
yeah, basically
hundreds and hundreds of billions of dollars. This is like one of the biggest pension funds in the world, basically.
They basically said it was like anti-competitive, right? Because like you're starving.
Well, no, it's not. No, excuse me. Sorry. The language is important. It was against the BlackRock's fiduciary duty, right? They have a fiduciary duty not to save the planet. Although, again, let's skip that for a second. Their point, that Texas's point, was they have a duty to maximize shareholders' return on a risk-adjusted basis, and to exclude an entire sector was not consistent with that.
And so that's so that people better understand this. When you invest in a market, and you're going to be in a fund structure usually of some sort, and if at the pension fund level, even it may not even show as a fund structure, and you might see securities up, but it is still part of a much larger block trading strategy. And then the firm behind it, the biggest one in the world, it is BlackRock. And so if the securities are in your name, you're holding them, or you can direct or guide the ultimate beneficiary of the securities, you can play a significant role in trying to direct the underlying companies on how to do things. So what Texas is saying to BlackRock, you guys are trying to force everyone into this ESG stuff, and that is going against our mandate. And that's where BlackRock has gotten into trouble now. And that's where the whole ESG industry and score. I still receive emails every week. I had one a couple of days ago from, I think it was Bloomberg. Yeah, come join us at the ESG summit, and this person, that person. I replied back. I said, dude, you're going to be out of a job. You got to stop.
Don't say that. That's just mean.
I think, you know what? You can see it as being mean, or you can see it as a wake-up call. And sometimes people need a wake-up call on certain
I mean, you know
things.
how I feel about it. I think it was a total and insane lie from the beginning. 83% of the world's primary energy comes from fossil fuels. That hasn't changed in 20 years, despite the trillions of dollars spent on renewable energy. So anyway.
So I'm hoping this young person who sent the email, I go, what's this? No one ever, you can't say bad things. You're going to hurt my feelings. but sometimes you have to hear it the way it is, and that's Texas telling BlackRock to screw off.
Yeah, and then a lot of other countries,
what it
excuse
is.
me, a lot of other states have done that as well. Smaller states. I mean, Texas is the second largest state by GDP in America after California and New York, or third. Anyways, whatever. It's enormous.
Yeah. I mean, I think the
Steve,
takeaway here.
have you ever had your feelings hurt while you're working?
Every day I talk to you say something mean.
Whenever I read the comment section, I always get my
the comment
feelings hurt.
section of YouTube's always good for a good down
Again,
day.
like,
What were you gonna say,
embrace
Steve?
it.
Sorry,
Say
we
thank
cut you
you.
off.
Thank you for it, and you go on. That's what you do.
No, I mean, I think that the message, the takeaway here, again, for the listenership is just try to keep your emotional bias and maybe your political views or your ideological views on the space out of it, and just look at and say, clearly, again, Keith, the pendulum has swung. I mean, we've seen even our federal government, the liberal parties, come out over the last 6 to 8 weeks saying, "Oh, it's a new era. It's a different world today. We need to invest in energy projects and get things approved and pipelines built." And it's like, well, I mean, you didn't feel that way over the last 9 years, but you're right now. They see the writing is on the wall. It's like you have to change and you have to adapt. Otherwise, you're toast.
Yeah.
So,
sure.
Keith, you wanted to chat last but not least on what's happening in the U.S. bond market, treasury market. So the U.S. 10-year has been falling. I think it's fallen now for 6 consecutive weeks. Yeah, I think it's 6 consecutive weeks now. Bond yields have plunged, which is the longest streak, I think, in 5.5 years.
Is that so?
They plunged. So we got it from what, 465 to 430? Something like that.
Yeah, we went from a peak of about 478 down to about 428 today. So you're down about 50 basis points over the last call it 5-6 weeks.
Yeah, that's pretty significant.
Basis points.
So I mean, so first of all, you have to distinguish between a trade and then a long-term trend. Yeah. It's my view. This is a trade that's taking place right now. So many people just short at the long end of the curve. It just got to a point where there's no one else left to short it, and that's it. So you get short covering taking place, and then you can get, you can call it a short squeeze. That happens sometimes in a market, which is very powerful if you participate in it. But this movement right now, I don't know how much lower it can go, because what's also happening at the same time is we're starting to hear whispers now that the American economy is maybe not as strong as what everyone has been talking about. And if we do continue to see a weaker data points coming up, so I know, Rich, you shared with us, I think it was credit card, was it delinquencies or charge-offs? I forget which one it was.
It's called delinquencies, but they're both rising.
Delinquencies is actually the worst one of the charge-off has already happened. But if this happens, and all else being equal, I mean, you can see the 10-year go down to, I'll throw the number out there, 3.25, 3, something like that.
You think?
And it could. I mean, you're at 1%. I don't think it's going to happen, truthfully. I just think,
but if you get down to
this is a
3.25,
trade.
so that's another 100 basis points from here. I mean, what kind of economic environment do you need to be in to see that?
Very bad.
It's looking bad if that's happening.
Yeah. I mean, there's Keith's right. I mean, there's some like starting to, there's some, we talk about little crumbs that you pick up along the way. You guys can be Hansel and Gretel. I'll be the witch. But like the point is like you got weak consumer confidence, weak housing sales. There's talk of they're going to start doing a little bit of austerity in a world where you had massive government, fiscal impulse that's going to go to fiscal drag. There's, you got the tariffs, which are not good for growth at all. Effectively, they are a tax on consumption, so that's bad for growth. Yeah, sorry, Keith. I mean, there's a couple of things that are starting to bubble up here.
Yeah, it could clearly go in that direction. And I don't know how much further we have left to run with this rally in the long bond. So you take advantage of it as it's happening. But what I see on top of this, we're going back to the nerd fight between you two guys again in some ways. But what I'm starting to see and hear and chat with other people in my network, the next big conversation that's starting now is whether inflation is going to begin to start raging again or it's going to collapse. That's what the conversation is. And the way you play that, it is with the 10-year. That's, that could be ground zero. So one of my friends, Julian Brigden, you guys know that name?
Yeah,
You might
yeah,
see him.
yeah. We should get him on the show.
I can ask him to come on, and he will. But he believes inflation is going to be raging. He said this is going to get out of control, but you don't know
So
when,
he's
of
super
course.
smart and very handsome, is what you're trying to say.
He's like he's like a
Julian
smarter,
is
better
not a
looking
looker.
boomer.
He's not a looker.
But he's very smart, because people who think inflation is going to rise are very smart, right?
Yeah. That's true. No,
He's
that's
got a
true.
hot wife.
A hot wife or hot wife?
Anyway, so oh my goodness.
Oh man, now we've gone the other.
Well, what I
But
mean,
this is the big conversation coming up, and it could be incredibly dramatic again for fixed income strategies. If we are in a slowdown and inflation is collapsing, and you are in a private credit fund or investment grade or high yield, what happens to your bond fund? Yeah, it's going down hard because credit spreads are going to blow out. If you're in a long, say 20, 30-year US Treasury fund, what happens with that guy?
you're gonna push higher.
Oh, it's going to party, man. It's going to party all night long. So again, it's such an interesting dynamic, but we have to watch how all this is starting to come
It's just
together.
interesting, right, to see the narrative shift. Obviously, like I think coming into the new year, right, the optimism was, Trump was pro growth. He was going to deregulate. We're going to have this economic boom. So, yields obviously pushed higher, anticipating that growth and inflation. And now, we're seeing obviously tariffs across the board, and people are saying, well, maybe this is not very pro growth. You're seeing Doge obviously eliminate a lot of these jobs. Ironically, reducing jobs in government, health, education, consulting sectors, which are actually the largest payroll sectors in the U.S. economy. And the narrative is now starting to shift, which is your 10 years rolling lower, your 10-year yields rolling lower, and people are now worried about um, lower, weaker growth. And I think the crypto space is reflecting that. We didn't chat about that, but obviously Trump coming in and being very, pro crypto, Bitcoin reserve, launching Trump coin and we're seeing the decimation in the crypto space. I mean, some of these, Solana's down 50%, Ethereum's down 40 plus, Bitcoin's down 20%. And that's an asset class that I think from a liquidity perspective kind of front runs the rest of the market.
Well,
I mean, by the way, everyone, you can never have crypto or gold a part of your reserves at the central bank because the amount of volatility that's attached to it.
Well, gold they have huge amounts of gold in reserve.
It's small, significant.
Well, yeah, but
relative to everything. Yeah,
yes.
People think we're going to that world. I just don't think that's going to happen. But like another big conversation that's happening now, it's so let's just say the Americans are successful with improving their deficit. So still a deficit, but it's not as big as what it was planned to be. So that then means the American government is issuing less debt than what they were before.
Mm-hmm.
And when they issue treasuries, that they're actually buying US dollars because they're sucking US dollars out of the system when they do it. So so that's dollar positive. Everyone always said, oh, the twin deficits, the trade deficit and the budget deficit negative, for the dollar. And the dollar is not collapsed. There's a lot of other things happening as well. But we could potentially be going into an experience now where if there is a dramatic improvement in the American budget deficit, and I don't think they're going to get it really at the end, but if they are able to make a significant one, all else being equal, it's going to be less demand for dollars coming out from around the world, and this could have a pretty dramatic effect on the world as well. And no one's talking about it yet. They don't, because they're all focused on other stuff. But and again, there were some really big, significant moving points that are just starting to nudge underneath. Inflation, no inflation conversation, 10-year credit spreads blowing out, US dollar or treasury issuance. And no one has seen this now for a long time. So, whereas last year, how much volatility did we have?
Zero. Everything went up. It was a
Yeah.
great year across the
Yeah.
board.
Everyone made money last year. And I think this year is going to be very different by the time the year's over.
Well, you're already starting to see it. Like if you look at year-to-date returns, you can see that the things that were the like poor last year. So like just the stupid examples, like India was one of the best performing markets last year. It's now the worst performing market this year. China was the worst performing market last year, and now it's one of the best performing market this year. All the treasury stuff that basically did zero last year is now doing okay. It's just funny how you sort of get the whipsaw that we're seeing it. And volatility is creeping higher, and yeah, it's gonna be an interesting. It's gonna be an interesting.
It's gonna
year.
be fun. I think it's gonna be a fun year. At the end of the day,
I'm trying not to lay it on too thick, but I mean, to me, this kind of stuff just really, really entertains. You're also seeing rotations internal sectors. So things that we look at are consumer discretionary versus staples, right? So things that people absolutely need to buy versus things that people buy with their extra disposable income. You're seeing a huge rotation there. You're seeing a rotation versus like the concentration. Remember we talked about the market was super, super concentrated with like just a couple of stocks dominating market cap relative to the S&P 500. That's starting to unwind a little bit, where like the equal weighted series is doing better than the S&P 500, which is another sort of little red flag. There's value versus growth that's also rotating. If you think of there's different factors, there's momentum factor, quality, whatever. And one of them is value and one of them is growth. And for the first time in a long time, value is starting to outperform energy versus tech. I mean, this is the kind of shit that you like live for in this business, right? These like inflection points, both politically, economically, inflation, bonds. Anyways, I love this shit.
Steve, Rich is pretty giddy there right now, isn't he?
Well,
I get happy.
I love my job. I love my job. I have to say, I'm very lucky in this world. I get to talk shit about stuff that I love to do.
I'm happy that he's happy.
Well, I am nothing if not authentic and sincere. So for better or for worse.
Well, I think that's a good place to wrap it up. Yeah, as always, guys, we appreciate the support for following along. If you've got any sort of value or entertainment out of the show here, all that we ask is you share the episode with at least one friend, family member, and we'll continue to build the Loonie Hour community. And still working on some good guests here throughout the year. And as things sort of ramp up here, we'll have again, all of these guests come on in a timely fashion. So as always, we'll see you next week.